Welcome back as we continue this insightful discussion with Dr. Adegoke Adegbami. Stay tuned.
Rising interest rates is a problem not only to the borrowers, it's also a problem to the lenders. Because don't forget that as lenders, we actually source the money from somewhere. And that same interest rate is affecting wherever we are sourcing the money from. Typically, we source our money from deposits. We source our money from also borrowing. We borrow from commercial banks. We borrow from development banks. We borrow from high net worth individuals to be able to serve our customers. When interest rates are going up, all these people, they demand for higher interest. You also know that we also use our shareholders' money. Well, shareholders also, they expect return, and there is opportunity cost. Somebody will want to say, okay, rather than me investing 100 million in microfinance and I'm getting a return of maybe 10%. If I can place that money, I can use it to buy treasury bill, I can get a higher return. So if you really want to keep your shareholders, if you want to make them happy, you have to be thinking of giving them also an improved interest, an improved return on their money that they invest with. So it's not only the borrowers that have problem with high interest rates, but also for us as lenders, it's a big problem because it increases our, it reduces our margin. It also affects the repayment because when money is too expensive, the likelihood of defaults is higher because typically in our own environment, like they say in Yoruba that whether it's somebody's money or it's your own money, what is important is that you get one. So an average person in our own society have this attitude. So they want to get the money first. And after they have gotten the money, they find it difficult to be able to pay the principal and the interest. So it increases the risk of default. Well, what do we do? Since this is the business we have chosen, we try to see how we can reduce costs in other areas, become more efficient, try to deploy technology. Technology has the capacity to bring efficiency, to reduce costs, to increase speed. However, we also know that technology is not free. You can achieve all these things, but you have to put some money in technology first. So, by and large, we try to balance this thing and see how we can stay afloat. Thank you. Competition is real and competition should be expected. Any business that is a good business will have competition. Now, digital lending has come to stay. Now, it has come with a number of challenges too, because typically you now have our own customers getting overexposed. That means they collect loan from me. They also go to these apps and collect small money from as many places as possible. And it also increases the rate of default of even the digital loans too. It's been a difficult thing. We don't have problem with competition. Competition must come. But what type of competition? So what I can say is that these digital lenders, we are also digital lenders in our own at our own level because we do some digital lending, but there are some that's what they do strictly, and then a lot of them are actually not regulated. Of course, the regulators are trying to bring as many of them into the regulatory nets, but that has not been fully achieved. Now, what do we do in our home case? You try to get close to your customer. You try to also sensitize your staff to let them know the difference between these people and what we do. Like I said, we do digital lending, but there are some that they do this digital lending without regulation, without ethics. There was some time ago when we were trying to go into this digital lending, maybe some 5 or 6 years ago. I have to apply online for a loan from one of those digital lending apps to actually see how it operates. And then when I applied, their system actually pre-qualified me. Immediately, the system said I could take 3,600, and that was very ridiculous. I mean, so initially I felt, what will somebody like me do with 3,600? But since I was trying to experiment, I had to take the 3,600, and the loan was given for 14 days, and the interest rate on it was 900 naira. So by the time you put 900 naira on 3,600, and for 14 days, if you calculated the interest rates, is in hundreds. Now, for us who are regulated, we can't do that. Our interest rate may not be like commercial bank, but I mean, there are still ethics, there are still governance, there are still regulation that we have to abide with. So this digital lending app, they come and hide all these things and lure people to get it. And oftentimes, when people get into it, when they are hooked in one, they go to another one, they are hooked in another one, they go to another one. And that their exposure brings lack of peace of mind. Lack of peace of mind affects every other thing they do, including their business, which is actually supposed to be the source of paying back what we give them, and also the source of them being able to do business, being able to deposit some money with us, and so on and so forth. So it's been a challenging thing. But what do we do when there are fakes? Part of the response, the good response, is that you bring the original. And what we try to do is to now say, okay, how can we use technology to do lending, but to be ethical, to also work within the law, within regulation, and to keep corporate governance. And that's what we have tried to do. As at the time we started, what we did was loan origination. People can apply online, and that enables us to get as many applications as possible. You can get like 100, you can get 300 even in a day. Then we have a way of investing and doing the appraisal on our own. When you have done the appraisal, then you take decision. When you have taken decision, then you get back to the people via technology again, and you can disburse. I will also move to a point whereby you can now have algorithm that can do the analysis, that can do the appraisal, and then make decision. When you get to that point, you also need to adjust your parameter. The size of loan you can do at that level has to reduce, so that because of the fact that there's no personal contact, you also have to increase your identification system, improve on your identification system, so that you can actually, if there is anything, any problem, if you want to trace some of these people, you can trace them. Yeah, good enough. We now have some some infrastructure that actually also enables us, like the issue of credit bureau, like the ID card system that um, uh, the national ID number is a prerequisite now. The bank verification number is a prerequisite. So you put all those things in and you use it to, via technology, do whatever you need to do to be able to serve your customer using technology. The other thing we have also tried to do is that, look, we don't only use technology to do loans alone, because we believe that you can't clap with one hand. It has to be a balanced thing. In fact, part of our primary objective is to actually encourage people to save and to get good return on their savings, not only borrowing, because borrowing actually does not keep you in control. What keeps you in control is your ability to save, grow your saving, get good return, and in the process of saving, you learn some financial discipline. So we now have technology that enables us to also collect deposits from our people. That also enables them to get to reach us and take their deposit whenever they need it. I mean, from our mobile application to our USSD to our internet banking, all these things, including our card channels, we encourage people to make sure that they save, not only borrow. Thank you.